CNBC TV 18, celebrating 15 years of leadership.
After 7 years, the insurance bill is finally set to become a reality. The select panel tables its report in Parliament, proposes a composite FDI cap of 49%, wants incremental equity to improve capital base of companies.
I accepted the 4.1% fiscal deficit figure from your interim budget.
Fiscal deficit had reached unmanageable levels, says Finance Minister Arun Jaitley in Parliament. Sources meanwhile tell us the government stands to gain nearly 75,000 crore rupees by compressing planned expenditure for this fiscal. FM promises once again to rationalise LPG subsidies, but sources say it's a long way from becoming a reality. Crude prices continue to crash as the 12-nation oil cartel OPEC cuts its demand outlook for 2015. Brent crude slips below $66 to hit its lowest level in 5 years.
RBI governor should quit if he has a moral ground.
Former Law Minister and Senior Congress leader Veerappa Moily targets the RBI governor, criticizes Raghuram Rajan for not easing interest rates in the Lok Sabha, also questions the governor over the PSU bank chief's appointment fiasco.
We do plan to put in an application for a small bank license by the January 16th deadline. We're also considering the payments bank as well.
Founder of SKS Microfinance Vikram Akula makes a comeback, joins via FinService. Chairman plans to seek a small bank license from the RBI. Setback for Vodafone in the 8,500 crore rupee transfer pricing case. The tax tribunal rules in favor of the taxman, says sale of call center business in India is taxable. India's IT capital could soon become a pharmaceutical hub. Karnataka lures 33 companies from Hyderabad by offering SOPs to set up shop. In a last-ditch attempt, the BCCI chief in exile, N. Srinivasan, tells the court he will stay away from the IPL as he seeks to contest the election to stay as president of the board. The election has been delayed.
Childhood is my religion and my God, so I work for them.
I will get my education if it is in home, school or any place.
Nobel Peace Prize for 2014 is to be awarded to Kailash Satyarthi and Malala Yousafzai.
It's not just an honor for me, it's honor for all those who are fighting against child labor globally.
So it really encourages me and strengthens me to continue the fight for education. And I feel that I'm not alone. We are many, we are millions who want to fight for education.
Well, for the first time ever, an Indian and a Pakistani, a Hindu and a Muslim together awarded the Nobel Peace Prize. Kailash Satyarthi and Malala Yousafzai honored for their fight against child rights abuse at Oslo. Good evening. Thanks very much for joining us on India Business Hour. India and Pakistan's Nobel moment coming up for you in just a bit. But let's kick things off with the day's trading action. The three-day losing streak is finally over, and a late surge on the Lal Street has lifted sentiment. The Sensex ended a volatile session with marginal gains. The index is still below the 28,000 mark. Ditto for the Nifty as it staged a recovery in the last hour of trade, ending in the green. But the mid-caps today managing to outshine the blue chips. The mid-cap index gained nearly 1%, so that was the story for our markets today. And market experts believe that the Indian markets are nowhere near the highs that they can reach in this bull market. In fact, they believe the government is making the right moves and that investors should use every correction or dip as a buying opportunity.
As far as the market is concerned, clearly I can tell you that, most Indian investors actually were looking forward to a correction because, most Indian investors are still underinvested in equity. and the correction actually gives them an opportunity to consider investing. We are very bullish with a 3-year view is India and US dollar, and so anything which is very dependent on India and is likely to benefit from the continuing strength in US dollar.
Well, that's S. Narain on our markets, which saw a pullback today, but oversupply worries continue to plague the oil markets, with crude prices resuming the downward trend. In its latest monthly report, the Organization of Petroleum Exporting Countries, or OPEC, has painted a very bleak forecast. It says collective crude oil production declined by 390,000 or over 390,000 barrels a day to 30.05 million barrels a day for the month of November, and that is just above OPEC's output ceiling of 30 million barrels a day, a level the cartel agreed to stick to at a meeting in Vienna just last month. Now, OPEC has also forecast the demand for its oil would drop to 28.9 million barrels a day in 2015, and that compares with 29.4 million barrels a day in 2014. Meanwhile, Algeria's energy minister has said that OPEC might hold an emergency meeting before June to discuss ways to tackle the global surplus. Nonetheless, Brent slipping below the $66 per barrel mark, while WTI has tumbled even further. Now Brent at 65.37 and NYMEX nearing 61.51. So crude reality continues to look ugly at this point in time, Netara.
And all of that is going to augur well for India's fiscal deficit. We'll get to that in just a bit, Shireen. But here's the other big story tonight. The 7-year journey of the insurance bill has reached its climax. The FDI hike in the sector to 49% is now a step closer to being a reality. The select panel has tabled its report in the Rajya Sabha, and that report has now minutes back been cleared by the cabinet as well. Here's a report on the key recommendations that were made by the panel and their implications.
The Chandan Mitra-headed Select Panel on Insurance today submitted its recommendations on 109 clauses of the legislation. The two topmost recommendations of the panel are a composite foreign investment cap of 49% and the definition of control embedded in the Act itself. The committee is of the view that incremental equity should be ideally used for expansion of capital base. Committee members defend this stand.
The basic reason why we are taking it up from 26 to 49 is that we want to give financial muscle to the companies so that there is greater penetration. Now the idea is to strengthen the companies and not give windfall gains to a few select individuals in this country. You may recall that at the time of 2G, this is exactly what had happened.
The panel has also allowed a proposal to empower the centre to allow GICs to raise capital from the market as long as the central government stake does not come below 51%. For health insurers, the panel has recommended to retain capitalization at 100 crores. For reinsurers, the panel has recommended change in definition of reinsurer to facilitate the entry of British firm Lloyds.
How long are we going to remain a country which doesn't have adequate health insurances? Forget other forms of insurances. LIC can take care of our life insurances. But you need to expand these sectors. Let any one of us go and get treated in a private hospital. World over, it is supported by insurances. Because we have adopted a conservative attitude, the sector has not grown.
For norms on insurance agents, the Select Panel has said that the agents can represent one insurer from the 4 segments of insurance. The report of the panel was opposed by the CPM, SP, JDU and the TMC, mostly on ideological grounds.
We are very clear about this, the bill should not pass. Right. So, 3-4 other parties share our view, I believe. SP, BSP, I believe, and 2 other parties, CPM, right. CPI, JDU. Right. Why would the Congress be in a hurry to pass this bill now? Right. They can think about sometime later in 2015 if they want to pass it at all.
The government is hoping to table the bill in the Rajya Sabha at the earliest, putting an end to this decade-long back and forth this bill has seen. In New Delhi, with Rituparno Bhuyan, Ashmit Kumar.
Joining us now is Rajiv Chandrasekhar, member of the insurance panel and the member of the Rajya Sabha. Rajiv, appreciate you joining us. Well, in a sense, your work is done because your committee has submitted its recommendations to the government. If I can talk to you about some of the issues that your committee has recommended. As far as the cap is concerned, it's a composite cap of 49%, but you also go on to say the committee is of the view that incremental equity should ideally be used for expansion of capital base so as to actually strengthen the insurance sector. Is this an observation? Is this a recommendation? Would you like this to be made mandatory? Would the government move towards making this mandatory? Because a lot of joint ventures and a lot of foreign investors who are already in this business had worked on the assumption of a secondary transaction.
No, Shireen, if you look at the real objectives and the logic and rationale behind the increase in FDI, it is really about bringing in more capital into the sector and therefore increasing insurance penetration and therefore giving consumers, additional choice and competition. Now, if you assume and if we start believing that that is the objective behind the increase in FDI, clearly, sale of shares by one shareholder to another shareholder, which results in maybe gains to one shareholder vis-a-vis the other, does not really meet the objective of penetration, expansion, and consumer choice. So I think there was a fairly serious consensus within the committee that given the objectives that have been laid out for the increase in FDI, that such a stipulation, such a directional cue to the government was necessary.
So this is a recommendation, but let me labor on this point, Rajiv, because I understand and I know you've made this argument in the past that directionally this bill is pro-consumer, it's pro-choice, and it shouldn't result in Indian promoters being able to get windfall gains out of a secondary transaction. But would you suggest or would you go as far as to recommend to the government that there be a mandatory ban on any secondary transaction?
Look, Shireen, I think, the way this will work is that the committee has made its recommendations. The bill will be then introduced by the government into Parliament, and then the Parliament will have a second bite at this in terms of a debate and if possible, amendments. Now, I know for a fact that a lot of members of Parliament are quite clear that this bill and this increase in FDI should not be to allow a certain class of promoters to essentially gain windfall gains and profit by way of sale of shares, and that is clearly not the objective of a legislation. Parliament cannot legislate to make people rich. Parliament can legislate to make consumers get additional choice and competition. So if that is the principle behind the bill, I suspect that Parliament, when the bill is debated, a number of MPs will basically insist on maybe further clarity and further mandatoriness about this. Okay. But that is for the Parliament to decide at the time of a debate.
Okay. Fair enough. Let me talk to you about the other issue, Rajiv, and that is the issue of control, because the select panel says the term control should include the right to appoint a majority of directors or to control the management or policy decisions included by virtue of their shareholding or management right or shareholders agreements or voting agreements. Are we to understand then that that issue of Indian promoters necessarily having control is not what you recommend?
No, I think this comes, Shireen, from the fact that when you have a sectoral cap of 49, and this is in some ways also linked to this debate on the composite cap versus, separation of FII from the FDI, that 49% sectoral cap implies that the sector requires Indian control and Indian management. Now, we have seen in the past in sectors like telecom how people have gotten around it by creating proxy Indian shareholders and so on. And I think there is a little bit of there are two schools of thought on this issue. One is, of course, there is a school that I belong to which says, why should insurance have any restriction of Indian management and control? This is a consumer product. This is, free competition, etc., etc. And then there is a school within the Select Committee and Parliament which says, no, this ought to be Indian control, which is why we have the sectoral cap. Be that as it may, and that will get resolved during the debate in Parliament, one point that I have made repeatedly is that this cannot result in a situation where we have rent seeking, where we have Indian so-called promoters with 10-15% shareholding in a company that effectively control a company with 15% of equity because of this legislation. I think the legislation implies that if an Indian promoter wants to control this, he has to invest 51% capital in it. You can't have, at the same time as the government of India is trying to create investments and FDI into the country, two classes of shareholders, which is...
Let me ask you an honest question, Rajiv. Do you believe that you're going to be in the minority as far as this issue is concerned? How do you see Parliament voting on this matter?
Yeah, no. It's not the first time that I will be right and in the minority, so I'm not going to be too surprised by that. I think that's fine. That's par for the course. I genuinely believe India is at the cusp of something big. We can't afford to have two classes of shareholders. We can't have preferential rights for an Indian shareholder over a foreign shareholder. All shareholders must believe that they have equal rights under company law. Where there is a sectoral cap, there should be a sectoral cap imposed on the amount of foreign equity, and that's where it should end.
Okay. Rajiv, let me very quickly ask you about some of the other clauses. Now, I understand that few members expressed their reservations on the issue of empowering the central government to allow public sector general insurance companies to raise money from the markets. But finally, the panel has agreed with the government's stand in this regard as far as clause 109 is concerned. So can we now see the government move towards general insurance PSU companies tapping the markets?
I think that the government will answer, Shireen. I think the point here is that there is a reasonable consensus within Parliament that the public sector companies in the insurance business must be strengthened, and they must have adequate access to capital so that they are equally empowered to compete as the private companies beef up on capital from foreign sources. So I think that issue, whether that translates into more public market tapping by these PSUs or government capitalization, that is for the government to decide both politically and ideologically. But I want to, Shireen, tell you one more aspect of this insurance bill that may not have really been picked up. One of the things about this insurance bill is that there has been more and more empowerment of the insurance regulator and less and less hard coding into law. One of the problems with the previous laws of insurance has been that there has been everything coded into law, including, for example, commissions for agents. This bill is really, in my opinion, a departure from the traditional way of putting everything into law, and it moves to a place where there is part in law and a lot of empowerment of the insurance regulator to then create flexibility as markets and environments change by creating regulations.
We picked up on that point, Rajiv, earlier this afternoon, but very quickly, I'm out of time, so I'm going to ask you two quick final questions. As far as health insurance is concerned, you've retained the minimum cap at about 100 crore rupees. Do you believe that that could come in the way of health insurance penetration? And secondly, we've heard from all sorts of numbers coming in that we could see 20,000 odd crores, 25,000 odd crore rupees coming into the sector once this bill is actually passed by Parliament over time, of course. What's your own sense?
On the first question, I think this is a little bit of a balance between the need to protect consumers from, let's say, unscrupulous fly-by-night health insurance providers versus creating a substantial entry barrier to real credible providers. And I think this at some point will be reviewed in the next couple of years to create more competition and more penetration in the health insurance space. So starting with 100 crores is probably fine, but it will need to be reviewed, in my opinion, in the next couple of years to bring the threshold down so that there are more and more models, including cooperative health insurance models, where the threshold comes down to 50 crores. In terms of investment, in my opinion, Shireen, the real test of this is going to be the overall economic architecture that the government unveils going into the budget. I think there is a lot of capital that is sitting on the threshold waiting to come into India, whether it's insurance or otherwise. But I think what the government does over the next 3 months leading to the budget in terms of unveiling the economic architecture of more independent regulation, more transparent policy making, and really put meat behind the minimum governance promise will really be what the test of the tap turning on or off on the FDI flows into insurance.
All right, Rajiv Chandrasekhar, appreciate you joining us, and thank you very much for joining us and explaining the rationale behind the recommendations of the select panel on insurance. In fact, staying with that story, remember, as we told you, the Cabinet has decided to take up the matter today, and it has in fact adopted the report of the select panel which was submitted to the Rajya Sabha. So that's one of the decisions that has been cleared by Cabinet today. For more on what the Cabinet has decided, let's go across to Sapna. She's standing by. Sapna, so insurance, the panel report has been accepted by the Cabinet. What are the other decisions? I understand there's good news for public sector banks as well.
Absolutely. In fact, the government has decided to lower its stake in public sector banks to 52%, and has taken the Cabinet note today on the same. This proposal had been pending for quite some time, and the indication that we had picked up was the fact that it's a top priority for the government. So this is an important move. The Finance Minister has been talking of this on this front since the last couple of months. It was just a matter of timing when do they actually go ahead and do so. In terms of what really this entails, or what this really means, is the fact that there was a perception that possibly capital infusion also along with the fact that they'll be allowed to lower the government stake, that could be part of the proposal. Well, that's not the case. The capital infusion will definitely happen by the government, but at a later stage as a separate part. So overall, as of now, it's a plain vanilla assent that the government has taken. It's a broad umbrella nod. It will be left to the PSU banks now to decide the modalities, the kind of options that they'll go for. Would they like to go for an FPO, or would they like to do it through some other mechanism? We are towards the last quarter of the current financial, and you also have the disinvestment pressure on the other side. So it really remains to be seen how many of them really come in the market and start lowering government stake. But this has been primarily done also to benefit immediately the big banks like Bank of Baroda, State Bank of India, Punjab National Bank. Here the government shareholding is already in the range of 55 to 59%. So these are some of the big guys who will be actually looking out for quick money probably towards the fag end of the financial year. As far as the government's capital infusion plan is concerned, I think they're just going to go ahead with a 3 to 4 year timeline, wherein they'll keep announcing the amounts to be provided in the budget. So basically FY16 will carry the allocation for next year, and so on and so forth. But there will be a 3 to 4 year capital infusion plan by the government as well, separately, not part of this proposal.
Correct.
Thanks, Sapna, for joining us with those details. So the amendments as suggested by the select panel for the insurance bill has been accepted by the Cabinet, and the other one, of course, to trim the PSB, government stake in PSBs to 52%. And Shireen, what's the sense that you get? Perhaps this is what's going to take precedence as far as the divestment drive goes.
I would imagine that, because as we've been reporting, and the Minister for Coal, Piyush Goyal, very categorically said that Coal India can now only happen in January. ONGC, as we've been talking about, that's been differing as well. So perhaps this could be what is part of the government's plan as far as this investment is concerned.
Right, and let's tell you a little more about what the government is planning. We understand from our sources the government is likely to cash in on the big savings on its expenditure budget yet again in this fiscal. Top government sources telling CNBC TV 18 unutilized funds in defense, health, agriculture and many other ministries is likely to help the government compress the planned expenditure budget in a big way. Planned spend for FY15, let's just remind you, had been raised from the interim budget allocation of 5.55 lakh crores to 5.75 lakh crores in the July budget. While Finance Ministry is still in the midst of working out and finalizing the likely compression of these numbers, ballpark indication seems to suggest the saving could be anywhere in the range of a massive 60 to 75,000 crore rupees. So what is this money going to be used for? We understand it's likely to help the government meet other policy commitments, including the payment of the next tranche of the CST arrears to states, and possibly also recapitalize public sector banks in FY16. Today the Finance Minister did announce 11,200 crore rupees would be the part compensation paid to the states for GST.
Absolutely. In fact, the Finance Minister said that in the Lok Sabha. He said he will release 11,000 crore rupees as part payment of CST compensation due to state governments since 2010 by the end of this fiscal. The lower house approved the government's supplementary demand for grants. Speaking in Parliament, Arun Jaitley stressed on the need to tighten the purse strings. He hinted at rationalizing LPG subsidies, saying we must spend within our means, but sources say any cut in LPG subsidy is unlikely to happen anytime soon. Here are the highlights from the Finance Minister.
In my meeting with the Empowered Committee of the State Finance Ministers on 3rd July 2014, I had committed that partial payment of the outstanding CST compensation will be released this year. I stand by this commitment given by me, and despite difficult and challenging situation, I propose to release about 11,000 crores, which is 1/3. This year, as a part payment of CST compensation to the states, this will take care of the amount from 2010-11 onwards this year. The balance amount I will start paying from the next financial year onwards, and hopefully the situation will be better. If you cut down expenditure by 1 lakh crores each, what does it mean? Revenue expenditure can't be curtailed, people have to be given their salaries, government establishments have to run. So what you cut down on is actually the planned expenditure, which is also the developmental expenditure. So when you put the economy in a contracting mood, cut down expenditure of the government, obviously it will have an impact on growth rates, and an adverse impact on growth rates will have a further adverse impact on revenues. This is exactly what has happened. So we inherited an economic situation of a negative sentiment. You'll have to honestly ask yourself a question. Last time I had asked Khadgeji whether Deepinder Hooda and Arun Jaitley are entitled to that subsidy. Or is the poor person entitled to it? And if you are going to say the rich are also entitled to subsidy, then please sit with me and tell me how a budget statement can be prepared if the rich are to be subsidized. The rich are not subsidized anywhere in the world. So whatever our tragedy is that when real politics overtakes what should be a shared vision between us, and the shared vision should be the poor people who are entitled to subsidy should get the subsidy. Those who are not entitled to subsidy should not get it.
The rich should not get subsidies, but the Finance Minister making it clear that will happen at a later stage. First, they're going to try and plug leakages, perhaps via Aadhaar and the direct benefit transfer scheme. Also in Parliament today, senior Congress leader and former Law Minister Veerappa Moily created a flutter in the Lok Sabha as he asked for the resignation of the RBI Governor Raghuram Rajan. Moily questioned the Governor over the appointment and then the cancellation of PSU bank chiefs. Finance Minister Jaitley clarified that the appointments made during the UPA regime were referred to the RBI only after a CBI report cited the irregularities in the process. Moily then mounted another attack on the Governor over his decision to not cut interest rates. Here's that exchange between Veerappa Moily and Arun Jaitley.
Same committee headed by RBI Governor selects, I think, 6 or 7 CMDs of the bank. After due diligence, everything, and you cancel that suddenly.
The manner in which the appointments were made, the marking on basis of which candidates were rated, and each candidate who in the normal performance rating of the last few years was not praised high, as a rule got 29 out of 30 marks in the interview. And therefore, after a CBI report, the matter was referred for reconsideration to the RBI Governor.
RBI Governor is the chairman while selecting it, practically same members. And RBI Governor and the same members, they cancel it. We should either the RBI Governor should quit if he has a moral ground, or the members. I don't blame you. Even on the interest rate, I will just finish that also here. Interest rates are concerned. Now it has become mature to reduce the interest. You agree, you have given statement in a number of places. Even the RBI Governor agrees that, it deserves to be. Japan has done it, reduced interest. China has reduced interest. All around, everybody has done it. But, you refuse to do that. That means it is not a sensitive government. You are totally insensitive to the problems of the agriculturists, farmers, insensitive to the industry, insensitive to the manufacturing sector.
Well, on one issue, both the Congress and the BJP come together that the Reserve Bank ought to have cut interest rates. On that note, it is time for us to wrap up this edition of India Business Hour. We'll be back with the trading action tomorrow morning. Till then, from the entire team, goodbye. Thanks for watching.
CNBC TV 18, celebrating 15 years of leadership.